With us now, Nigel D'Souza, an investment analyst at Veritas Investment Research. Nigel, thanks for being with us. Appreciate it. And I guess, well, let's start with just what you're looking for. I know there is this expectation that this quarter will see the effect of some of the recent events. What's your expectation of how the banks perform?
Thanks for having me on, Amanda. I think overall, the quarter should be relatively uneventful. I mean, there are a few things we're looking out for. The first is on the credit loss side. We think credit losses should be relatively mild. And one of the reasons for that is the substantial buildup of performing loan loss provisions over the prior two quarters. And, a second factor that's at play as well is deferral programs ending. So although the majority of deferral balances are expiring this quarter, we think the banks and the clients have to likely go through multiple billing cycles before delinquency and impairment trends emerge for the deferred book. So 2021 will give us a better perspective of expected credit losses related to deferred balances. Another factor I think that's important this quarter to look at is loan growth. So loan growth is expected to soften, and that's largely from lower economic activity coupled with extensive government stimulus. So outside of mortgages, which continue to benefit from a very healthy and robust real estate market, we do think loan growth is going to be a bit soft this quarter. And the last thing we're looking at is, or we're going to pay close attention to, is capital markets revenue. So capital markets has benefited significantly from unprecedented volatility and liquidity over the prior two quarters. As that normalizes, we think capital markets revenue is set to decline this quarter. So we see that coming in a bit softer than expected. But on the whole, we think the banks are well positioned to meet or exceed estimates for the fourth quarter.
We see this information from Equifax that suggests that there has been a growth in debt by the folks that are deferring their mortgage payments. So folks who are taking advantage of a government program on the one hand are taking on new debt on the other hand. Is that just, people taking advantage of the system that's in place, which is a possibility, or is that the potential for risk ahead for some of these lenders?
Well, I think it's also important to split it up between the Canadian experience and the international experience. So, what we've seen in major U.S. banks is a contraction in loan balances in the most recent quarter. Canadian loan balances could be more stable or could grow. And like you said, that could be due to the consumer tapping into bank credit to fund spending needs. But what we are seeing in general is that the deferral programs coupled with stimulus programs resulted in a substantial buildup of savings. And consumers and businesses are probably more likely to tap into the savings that they've built up than lean on bank credit. So we could see consumer balances tick up, but ultimately what's going to matter is the recovery from COVID-19 and the reopening of the economy and how we navigate the second wave. We think that'll play a large part in how credit losses develop, and also the vaccine distribution timeline. So remains to be seen.
What do you think drives growth for Canada's banks? I mean, one of the big concerns had been that if we saw even a normalization of loan losses, it would affect their profit outlook and the stocks would have to come down. Is that behind them, or is that still the potential when we think about the housing market and what it's behaving sort of abnormally in certain parts of the country still?
So it looks like at the moment the market is, for the most part, looking past near-term risks related to the banking sector due to a second wave or potential loan losses. In a normal environment, higher loan losses typically do result in banks underperforming. In the current environment, the market appears to be looking at the post-COVID-19 pandemic earnings run rate for the banks. We think it's a bit premature to do that. I mean, there still are near-term risks related to COVID-19, how the second wave impacts on employment or economic growth, because there is going to be additional stress on households and on businesses until a vaccine is widely distributed. Whether or not the market looks past those near-term risks is hard to say. I don't think it's warranted, and I think it's a bit premature to pay a higher multiple for banks and ignore those risks because we're not out of the woods yet. But how the market reacts remains to be seen.
What are you watching? Are there any banks in particular that you're watching, Nigel, for anything that you think might be a slightly different from the others?
So when we look at the banks as a group, I think you want to focus on banks with a higher presence in international markets. So if we think of areas where earnings surprise could potentially develop, it's more likely to happen or occur in international banking segments. So that would impact Bank of Montreal, Scotiabank, or TD Bank. So for Bank of Montreal, we want to keep a close eye on their U.S. commercial lending portfolio and how the pandemic has impacted commercial lending in the U.S., particularly for commercial real estate. That's been disproportionately impacted by COVID-19. So we want to see if there are any counterparty-specific or idiosyncratic loan losses that emerge in this quarter. For Scotiabank, it's going to be dependent on Latin American banking. Those regions have had a severely negative experience in relation to COVID-19. And the economies in Latin America are more tied to the global economy and to trade and commodity prices. So there could be a potential for Latin American operations to perform worse than expected. And then lastly, when you look at TD Bank's U.S. retail banking segment, U.S. retail banking tends to experience higher loan losses in the fourth quarter and the first quarter due to seasonality. So if those loan losses are higher than expected, or if the impact of the pandemic in the United States translates to higher loan losses or weaker earnings for U.S. retail banking, that could potentially lead to an unexpected surprise for earnings this quarter.
When you have gotten more positive on the banks, what's been the primary reason for that? You just changed your rating on 3 of them. What drives the kind of improved outlook when it does come?
So, to be clear, as a whole, we still think there are headwinds for the banking sector. We think there are headwinds on the earnings side, and we think the banks are currently trading at a premium valuation. So for the sector as a whole, we would still recommend that investors underweight Canadian banks. But with that being said, we do think banks that have a higher concentration in Canadian banking, so that would include CIBC, National Bank, and RBC, we do think those banks are more likely to experience less earnings volatility. And we think banks with a higher presence in international markets like BMO, Scotiabank, or TD Bank are more vulnerable to a wider range of potential credit losses or negative experience. And that could also translate into higher earnings volatility. So we expect banks concentrated in Canada to outperform. Of course, a caveat to that will be the timeline and distribution of a COVID-19 vaccine. If certain countries get a vaccine significantly in advance of other regions, then you could have a mismatch in the timing of economic recovery, which would change the outlook for growth in Canada versus international markets, or for credit losses in Canada versus international markets. And we also want to pay attention to Canadian real estate. Canadian real estate is an incredibly important asset class, and it's performed really well during the pandemic. But with deferrals expiring, there's a potential for individuals that were deferring their mortgage to face financial hardship, especially during a second wave. And if those individuals need to list their property for sale, we could see higher supply for Canadian real estate. So if that translates to softening prices or decline in real estate prices, that could potentially be negative for Canadian banking as well. But it's too early to call that. So those are just factors we think you should pay attention to.
And we will. Nigel, great to have you with us. Always appreciate your time. Nigel D'Souza is an investment analyst for financial services at Veritas Investment Research.